Hi, and welcome to another breezy, beautiful day in Palm Beach. I want to talk a little bit about price and risk, because when you're investing, price is everything. Regardless of what you're buying, price is always the primary driver of return and risk. On that topic, investors have been conditioned to believe that they're being conservative and careful simply because they diversified exposure to the stock market rather than being invested in a more concentrated number of securities. But here's the thing, whether it's one stock or 500, the more you're overpaying, the more risk you're taking on. Japanese investors thought they were being prudent in 1989 by owning diversified exposure to the Tokyo stock market. Following the crash that occurred in 1990, they're still underwater over 30 years later. And if you're thinking it can't happen here in the US, it already has. Following the crash in 1929, it took 24 years for US stock prices to reach their prior high. And after the tech crash in 2000, the S&P 500 took 12 years to breach the prior high. My point is this: you can overpay for a market to the same extent that you can overpay for an individual stock. Investors who own diversified exposure to the Japanese stock market in 1989 or the US stock market in 1929 or 2000 still got killed. There's nothing inherently safe or conservative about having diversified exposure to an extremely overpriced market. In reality, in a market trading near all-time highs, the most conservative strategy may be to avoid broad exposure and seek out investments trading at more reasonable valuations. Again, because price is the primary driver of return, the more overvalued your purchase is, the lower your returns going forward will be. It's simple math. And here's some more basic arithmetic to keep in mind. If your portfolio is down 50%, you need 100% gain just to get back to break even. The higher the market climbs, the more risky it is to own the market. So be careful out there. And thanks for listening.